You have decided you are done with renting and you want to buy a home. Or you want to buy a different home and you just haven't thought about the process for a long time. An article on Forbes.com predicts that the housing market in 2019 will be characterized by continuing rising mortgage rates and surging millennial demand. Millennials will continue to make up the largest segment of buyers, accounting for 45% of mortgages compared to 17% baby boomers and 37% of Gen Xers. This illustration by Realtor.com shows those percentages. Sometimes the stress of not knowing what to expect can take the excitement out of buying your new home. The paperwork and choices can seem overwhelming, but if you know some of the terminology, you will be a more confident consumer. I was in the banking and finance field for over 20 years, and I love the idea of empowering consumers to make confident financial decisions with some basic information. Today I will tell you about figuring out your budget so you know how much you can borrow, choosing a lender to get pre-qualified so a big chunk of paperwork is already done, a list of documents that are needed, understanding the terms and definitions used, and things to look for while shopping for your home. Let's begin by figuring out your budget so you know how much house you can afford. You are in the best position to determine the payment amount that you are comfortable with. Just because the bank says you can pay for it does not mean that is what your payment amount should be or the amount of money you should borrow. There's no sense in looking at a $300,000 house if you can't afford it. You can start early by making a list of all your monthly expenses. Things such as health insurance, retirement savings, student loans, utilities, car payments, credit cards. Also include yearly expenses such as taxes, insurance, and vacations. You do not need to include your current rent or mortgage in this amount. This info was taken from consumeradvocate.org. Subtract total of expenses from your take-home pay. This will tell you how much you can afford to spend each month on your new home. You can go online and use a mortgage calculator to get an estimate on what your total mortgage will be, and also search for current interest rates. Just keep in mind that your interest rate will vary depending on the type of loan, size of loan, life of loan, and your credit score. Now you should have a basic idea of how much you can afford to spend each month on a mortgage. You can streamline the process by becoming pre-qualified or pre-approved with your lender. Pre-qualification is usually cost-free and may be available by phone. You supply the lender with basic information of your overall financial situation. They supply you with a general idea and the types of amount of loan that you can qualify for. Pre-approval is more in-depth. You will actually fill out a credit application and there's usually a fee involved. You provide the lender with specific documents and they will give you more information based on your credit checks. At this time, you can usually lock in a rate. This step allows you to focus on homes that you are truly qualified to purchase. Now let's go over the documents that you will need to provide to the lender. There are some basic documents that the lender will want at the time of the mortgage application. This information came from www.centralbank.net. They will want your employment income verification. Submit at least 2 years of your W-2 statements, 30 to 60 days of consecutive pay stubs, including year-to-date earnings, any proof of additional income such as Social Security, child support, alimony, or freelance work. Submit your personal federal tax returns for the last 2 years. Business tax forms if that's applicable to you. You will need proof of asset verification, and that is normally 3 months of checking, savings, and investment statements. For collateral, you will need a signed sales contract on the home you wish to purchase, the name, address, and phone number of the insurance agent, contact information on the title company, and a copy of the earnest money check. Here are a few of the legal documents you will need. Copy of your photo ID and or permanent resident alien card. In some cases, copy of a revocable trust or a divorce decree. Now you've turned in all this paperwork to the lender and they start talking in a language that you do not understand. What do all these terms mean? Here are some terms the lender may use in your visits. Don't be afraid to ask for more information and for them to take time to explain everything to you. Make sure the lender is not pushing you towards a product that suits their own needs instead of a loan that would work best for you. Here are the 4 basic mortgage options. Fixed rate, a rate that will stay the same for the entire life of the loan. Adjustable rate, or an ARM, which comes with an interest rate that will fluctuate over time with the changing market conditions. Ask the lender how long this rate will stay fixed, about the maximum annual adjustment, highest rate, or cap. There are certain FHA or Federal Housing Administration loans that only are available to those who qualify. These loans could be for first-time homebuyers or tailored to low-income consumers and typically have more favorable terms. There are loans for veterans that are backed by the Department of Veteran Affairs that require a smaller down payment than conventional loans. You should be familiar with the 5 parts that make up the legal document that is a mortgage. The lender will use your house as collateral, which means the bank can take your home if you fail to pay back the loan through a process called foreclosure. The amount of money the bank lets you borrow is the principal. You can reduce this amount by applying more funds to the down payment. Interest is usually expressed as percentage rate, and this is the cost the lender charges you for borrowing the money from them. Taxes are collected when you buy a home and are based on a percentage of the home's value. These tax dollars are collected by local government and used for education, roads, and public services. You are required to purchase home insurance to protect the property in case of theft, fire, or natural disasters. Here are some other basic terms you should be familiar with during the loan process. We discussed the interest rate earlier, which can vary based on the type and size of the loan and your credit score. The lender may refer to the APR, or annual percentage rate. APR is the interest rate and all other fees divided by the term of the loan. You may be required to purchase private mortgage insurance, or PMI, if your down payment is less than 20% of the purchase price of the home. You can renegotiate this with your lender once your equity has reached 20% or more. Certain types of loans offered by the VA, FHA, and USDA may allow a down payment of 0 to 3 to 5% instead of 20. Closing costs are fees that are paid at the end of the transaction when the home is ready to transfer owners. Closing costs can be paid by seller, buyer, or a combination. Closing costs may be 2 to 5% of the home's purchase price. The fees that are generally included in the closing costs are the appraisal, credit report, title policy, pest inspection, recording fees, taxes, and escrow. A good faith estimate must be provided to you by law within 3 days of your application to disclose all costs and fees associated with the mortgage loan. One type of escrow refers to the time between the moment the buyer agrees to buy the property and the closing of the transaction, or when the title of the property passes to the new owner. The buyer is asked to deposit money into an escrow account as a good faith guarantee that the contract will be fulfilled. The down payment and closing costs must be in escrow before the property can be transferred. Another type of escrow is charged monthly, along with the mortgage payment, to pay annual insurance and property taxes on a real estate, instead of paying a lump sum once a year. Now that we've discussed the loan paperwork, let's start shopping for our home. Some home shoppers may decide to go it alone, but most will enlist the help of a realtor. A realtor can often answer some questions for you, such as, what is the lowest price the sellers will accept? How many offers have been made on this home? Establish a good relationship with your realtor. Try to get any extra information that he may have on the homes they show you. Set up multiple showings in the same day. Take lots of pictures of things you like about the house or problem areas. Think like a detective. Look for all the signs that something isn't working properly. Flip on the light switches, flush the stool, check the faucets. Keep a wish list of things that you're looking for in a property. Take a good look around the neighborhood, then come back at night when the neighbors are home and see what it's like. When you have found the right house that you can afford, your realtor will submit your offer to the sellers. If your offer is accepted, your realtor should schedule an inspection for the home. If anything needs to be fixed or repaired, you need to decide if you want the seller to do it before finalizing the sale. The lender will coordinate the appraisal. You need to do a final walkthrough before closing on the house. Congratulations, you just bought a house. Today we've discussed the process on how to purchase a home. So I hope this information is helpful to you in the future so you can feel more confident and prepared the next time you consider searching for your dream home. Thank you.